Okay, well, this year marks the 10th anniversary since the onset of the global financial crisis, the famous GFC. The credit crunch that changed the world and in many ways serves as a demarcation line in reshaping economies, financial markets, politics, even our culture. And it remains unfinished business. So few predicted that the topography of the post-crisis period would be so foreign. We've had freakish monetary policies that dragged interest rates below the previously unthinkable zero bound. We've had advanced economies stuck in slower for longer growth phases. And we've had, even recently, rapid wealth convergence of the developing world with the developed one. Last year, China contributed a near 40% to global growth, dwarfing the contribution of other major economies. And despite all this, we've stuck to our investment process. Clients have experienced great performance not only this year, but also over the long run through the global financial crisis and other inclement market periods. So our global thematic style has been crucial to this success, and we've cautioned investors to stay focused on what we like to call the world's super trends, those longer running themes that will be heavily influential on the economy and global capital markets over the next 3 to 5 years. And this has served our clients well, and we believe will continue to do so. So today I want to share with you 3 of these so-called super trends. First, the end of quantitative easing, perhaps the key monetary program central banks used to counter the downturn of 2008. And worldwide, many central banks are still running QE programs, but the US Fed has at long last declared the end of QE and will begin so-called quantitative tightening, QT, this month, gradually lowering their holdings of treasuries and mortgage-backed securities. So how should investors respond to this environment? I think the natural inclination to think is that if QE was positive for asset prices, then simple logic suggests that QT would be negative. If only it were that simple. It's important to note that a widespread misunderstanding of QE has defined the post-crisis period. Many simply got it wrong, forecasting that the monetary largesse created in response to 2008's financial crisis would lead to soaring inflation and crashing bond markets. Actually, the opposite occurred. Bond yields shrunk across the world, and deflationary forces have remained stubbornly present. So we have to ask the question, what did the consensus miss? And we say they misread the transmission dynamics of QE. What is now clearly known and forecast as early as 2009 by our investment team is that QE had more impact on the financial economy than the real economy. The liquidity created was distributed to capital owners, in other words, the wealthy, who have a far lower marginal propensity to consume compared to the lower and middle classes. Therefore, the injected liquidity boosted asset prices rather than being multiplied by the credit and banking system. This at least partially explains the apparent paradox of rampant asset price inflation with lower consumer price inflation. So given the above, a useful exercise today is to ask if most market participants missed QE and got the dynamics wrong, what could we be missing now? To start, I think we must acknowledge that an impending QT, quantitative tightening, is unprecedented. No one knows for sure what may unfold, but there are strong reasons to believe that the Fed's actions will have less impact than they have in the recent past. And retrospectively, and perhaps as would be expected, QE had a bigger impact the closer it was to the global financial crisis. We read a comprehensive study last year by the Bank of England, and they found that QE had double the effect on economic growth during the panic period of the financial crisis compared with later iterations. So now removing QE when markets are functioning reasonably well and reasonably stable is very likely to have far less impact than if markets were in turmoil. And today the actions of central bankers have become predictable and may even say even boring. Every major world central bank is committed to a gradualist approach, and therefore compared to the fast-moving dynamics of QE during the financial crisis, when central bankers were desperately trying to boost confidence in the actual entire financial system, QT will be what we've called a glacial affair that plays out over several years. It's not the equal and opposite of QE. Now, a second super trend our investment team has spent much time researching is the country of China. And many investors continue to call for a crash. They've called for a crash for a number of years. But let's try to separate fact from fiction. So it's no secret China is definitely slowing. The country's GDP growth averaged 11% in the period from 2002 to 2011. It's now about 7%, and further moderation is almost certain in the years ahead. But much of China's slowdown has been coordinated by official policy. China's new, slower path is driven by, I think, a broad recognition that the growth model of the last 30 years is neither balanced or sustainable. The new model that the Chinese government does recognize is that they must rebalance away from export and investment-led production towards private consumption. Now, GDP per head in China is approaching about $10,000 USD per year. To move beyond this level, policymakers know productivity must dramatically improve. That requires a litany of change. We need reduced corporation. We needed rights for the middle class. We need an improved operating environment for the private sector. And a crucial next step is to establish what we have in the West, which is a robust social safety net, and thereby reduce the fear-driven high household savings rates. Savings rates in China are enormous. And this will ultimately lead to a virtuous cycle of consumption, job growth, and ultimately higher real wages and corporate profits. So China is also moving from the rapid industrialization stage of growth, where the main objective was to build up infrastructure and heavy industry, kind of what we know China to be like now and popularized in the media, to the resource efficiency stage, where the main goal is to maximize the return on investment. Therefore, over the next several years, we should see a China that will be slower, but you can say higher quality growth due to reduced capital waste and improved profitability. Lastly, it can't be ignored that China has an eye-watering amount of debt, but the fundamental reason behind this credit surge is rooted in its high saving and banking-centric intermediation system. Chinese households have long been the primary providers of savings in the economy, and their assets are far larger than their liabilities. So when you view it from a balance sheet perspective, the debt situation is much less dire than commonly perceived. And further, the China bears ignore that most debt has been used for infrastructure buildup rather than funding consumption. Imagine that in any Western country. So the makeup of China's stock market is also rapidly changing. This year has seen the most IPOs in the market's history. And the neat thing about this is that the Chinese stock market will come to more closely resemble the underlying economy as a whole, rather than being dominated by state-owned enterprises. So now is the time to be invested in an unloved sector. And as China makes progress in the face of the many naysayers, equities, we think, have much more room to be revalued upward, with volatility, of course. And over time, Chinese bonds are also likely to become core assets. The interesting thing this summer is during the North Korean flare-up, the Chinese renminbi acted as an effective hedge, rising versus the US dollar during the conflict. And what we conclude from that is that the world's so-called safe havens are indeed changing. They're changing from traditional government bonds to things like the Chinese currency and different asset classes around the world. Now, to close here, a final super trend I wanted to share with you is the Trump administration. We would be remiss not to mention something about that. And despite all the noise surrounding this presidency, the money manager's job and our job for clients is to put things in perspective by pointing out what counts for client portfolios. And of course, I think for Trump, the critical question for asset markets is how much business can hope to gain from the new administration's promised tax cuts, infrastructure, and deregulation. And the fog is somewhat thick, but some of it is lifting. And I'll tackle each of these three in turn. First, infrastructure spending. It's now clear that there will be significantly less than the $1 trillion of new investment promised by the Trump campaign. Elaine Chao, Trump's transport secretary, has repeated several times that the federal government accounts for only 16% of US infrastructure spending. That means less than US $200 billion of federal money. So the rest is up to state governments. Where they will raise the money seems not to have been a consideration, except floating the idea of more public-private partnerships. In any case, it's clear that there's no sense of urgency to any of this. Even if the $1 trillion infrastructure promise could be financed, it was meant to be spread over 10 years. How about taxes? Here again, a huge chasm lies between the promised biggest tax cut in the history of our country and reality. With savings from an Obamacare repeal and revenues from the border tax adjustments, both not likely to materialize, the cuts are constrained by the amount of deficit financing fiscal conservatives in Congress will accept. So finally, what about regulation? This is actually the most encouraging development. Both the Treasury Secretary and Commerce Secretary are clearly determined to deregulate wherever they can. And even if the congressional Democrats block specific changes like Dodd-Frank, the administration has room to weaken regulations simply by reinterpreting existing laws. So what we've been saying is Trump's sectoral impact will be substantial. And from that perspective, US policy should support financials and be neutral to negative for infrastructure companies and energy, as prices should stay soft while the supply continues to ratchet up. So I've shared with you three super trends. And as a reminder, you can go to our website and download our entire quarterly report, which documents each super trend and discusses the specific investment implication from each of those super trends. And our investment team continues to focus on building the best global portfolios for clients. Currently, that means that our portfolios are seeking income from all around the world, not simply relying on dividend-paying equities or domestic bonds. And we're what in the industry calls overweighting the best global growth exposures that we can find. David Kletz has discussed our strategy for emerging market exposures, and we continue to expect that this will be a great source of not only return, but also stability for the years ahead as these countries advance and become more integrated into the global economy and become more perceived as what I've discussed as safe havens. And as always, all client portfolios remain globally diversified. That continues to be the best way to avoid the big mistakes that can result from large declines, and the best way to protect and grow your wealth over time.